Hello and welcome on board FM Mock Debrief. I'm Rashad Hussain, your expert tutor for FM. Today, we'll be looking at section C, Nexus PLC, which is a 20-mark question and has three requirements. It's on the topic investment appraisal. Let's start. This question, Nexus PLC, requirement A is to calculate net present value of the investment and comment on its financial acceptability. Now, NPV here, we do have an advanced NPV. A lot of things to consider here. The question says there is an initial market survey which is considered to be an irrelevant cost. It is not going to affect our decision. The setting up of the plan is expected to be 800,000. We will have to calculate depreciation on that. The new project is expected to have a life of 4 years. Uh, the scrap proceeds is expected to be 250,000. The 4 years demand is given in liters. The selling price per liter is 100 per liter. The variable cost per liter is 30 per liter. The annual fixed cost, which includes depreciation and 10,000 of the apportioned headquarters, the annual fixed cost, we will have to remove the irrelevant items such as the depreciation, non-cash item shall be removed. The apportioned headquarters cost, also considered to be irrelevant cost, shall be removed, and 100,000 minus 60,000 minus 10,000 will give us a 30,000 of the fixed cost, which shall be considered to be relevant. Now the tax, be very careful, tax is not at the rate of 30%, but rather it is 33%, and it is in arrears. The working capital is also there. It's an incremental working capital approach. It is 10% of the sales. As sales increase, the investment in working capital is also increasing. The cost of capital, the discount factor that is relevant here is 10%, and the depreciation is 25%, reducing balance basis, which shall be calculated on the purchase cost of the asset, which is 800,000. Now, the CFO suggests that NPV for investment appraisal emphasize the method alignment with long-term objectives. However, some finance manager expresses concern as their performance and evaluation are more tied to annual profit. Now let's draft this NPV pre-filling basic format. With the pre-filled data, let's start off with the calculation of tax savings on depreciation. The depreciation is supposed to be calculated not including the market survey but excluding it the planned cost, which is 800,000. On the 800,000, depreciation at the rate of 25 percentage across all the 4 years, and after depreciation the opening balance minus depreciation will give me the second year opening balance, like that the third, the fourth, and finally the closing balance at the end of the fourth year. Now the most important thing is to understand is that the fourth year, the final year of the project, the depreciation is supposed to be passed in such a way that the closing balance of the asset is supposed to be equal to the sale value of the asset. What is the sale value? The sale value is 250,000. So what I need to pass is, I better than taking 25% here, the easiest method is to take the opening minus 250,000, will give me the depreciation of how much? 87,500. Now on this depreciation, or rather the tax allowable depreciation, we've got not 30 but 33%. Be careful, it is not 30%, it is 33%. There are several times the candidates, they wrongly pick up 30 and they end up in wrong figure, and across all the years the tax savings on depreciation is at the rate of 33% of the depreciation. The next working note that we can do is the working note for calculation of working capital cash flows. How many liters do we have? We have got 2000 is the first year demand, second year 4000, then 6, and in the fourth year it is the 8,000. On these, the income is, the sale is how much? 100 per liter. Copy paste will give me all the sales. This the working capital requirement is 10 percentage of the sales. 10 percentage of the sales. Incremental working capital, initially I'll invest 20,000. Second year I don't have to invest 40, I've already invested 20, the balance again 20. And this is going to be my incremental working capital. The working capital cash flows shall be required 1 year in advance, and in the final year the entire working capital whatever we have invested, which is 80,000, shall be recovered in the final year of operation. Now we have done with the working notes, moving with the NPV calculation. Sales, I can give reference to the sales. Sales income, I can go pick the sales probably from here, the sales income, giving reference, copy paste, East across 4 years, I've got the sales. Now the variable cost. How much is the variable cost? The variable cost again for comfort. I can do one thing. I can go pick the letters below and multiply it by 30. Multiply it by 30 and copy paste to get all the variable cost in one shot. Now after this, the annual fixed cost, we've got to show it. How much is it? It is not 100,000, 1, 2, 3, 100,000. To that 100,000, what is it? 60,000 depreciation. I've got to remove it. I've also got to remove the 10,000, which is the apportion overhead, which is considered to be irrelevant. After that adjustment, how much will I get? I'll get 30,000. Annual fixed cost across all the year is 30,000. Operating cash flows after summing all three of these, the operating cash flow after summing all three of these, I get the operating cash flow. And on these operating cash flow, I've got tax in arrears, the tax expense on operating cash flow, tax in arrears. So this is going to be across, it's going to come one, first year will be on the second, second will be on the third, third will be on the fourth, and the fourth will be on the fifth. And tax allowable depreciation, I can go pick that tax savings from the table below. It's again in arrears, the benefit is in arrears, picked it in arrears across 2 to 5 years. Then working capital cash flows, we can go down, pick the working capital cash flows, select those cash flows, copy, paste it up, and the working capital. Now, how much is the initial investment? Initial investment is 800,000. The scrap proceeds at the end, which turns out to be 250,000. All of these total cash flows, the sum of these, do not mistakenly total the first three cells, which is sales, variable cost, and fixed cost, which we have already totaled at where the operating cash flows. Getting all the cash flows all the way from year 0, 1, 2, 3, 4, 5, finding the present value of inflows, which is NPV, the discount factor at the rate of 10 percentage, comma, select the cash flows, do not select year 0, and then the NPV will be year 0 plus the present value of inflows, which gives me an NPV of, what is it, 163,800 13.9, or rather 163,814. Now, the most important thing is the comment here. What is the comment? The comment here is that the NPV is positive. Positive NPV projects is going to increase shareholders' wealth, and what is it? The project shall be recommended. Now, let's have the comment incorporated. The NPV of the project is positive. How much is it? 163,814. Positive NPV projects increase shareholders wealth, and the investment project project is financially acceptable, uh, because it has a sub substantial positive NPV. Now, probably other thing what you can note has comments is about why we are not picking up the market survey, why we are not taking the market survey. The initial market survey is not picked up as it is a sunk cost. It is considered to be irrelevant and it shall not be considered in NPV calculation. You can note that down. You can also note down that the 60,000 of depreciation, which is mentioned, is a non-cash item and hence not included in the cash flow. And you can also further mention the headquarters cost, which is apportionment, is irrelevant for this decision and is not picked up in the NPV calculation. So this is as far as the requirement A is concerned. And here let me go back, show you so that you can maybe, I'll slowly scroll down. You can also probably check your answers accordingly. And the two working note one, which is calculation of tax savings on tax allowable depreciation, and then the next one, calculation of working capital cash flows. And finally we have got the comment over here. Now moving on to the requirement B and C. The second and the third requirement, requirement B and C. Requirement B is to discuss difference between NPV and IRR, and also in context of mutually exclusive project, we've got to discuss which method is preferable, and it is for 5 marks. What are the points that we need to discuss over here? We need to say that NPV gives the figure in an amount, whereas IRR is in a percentage. So how do we present this NPV in an amount? What is it? It's absolute. It speaks about absolute increase in wealth. Whereas IRR looks at a percentage. And what is this percentage? IRR looks at relative rates of returns. And when we look at relative rate of return, it's going to ignore the size of the investment. Now, IRR is technically difficult and there are certain limitations to the use of IRR. IRR assumes that a proposed project is discounted at a cost of capital which is equal to the return that the shareholders want, and hence we are able to calculate the increase in the shareholders' wealth. And this is directly linked to the what is it, objective of the company, which is to increase shareholders' wealth. Whereas IRR calculates what is it, the rate of return on the project, has a what is it, it is reinvested at the IRR rate itself, and it shows a percentage which is going to show the attractiveness to the shareholders. IRR does not measure anything in absolute increase, it just gives a percentage. And if we look into the mutually exclusive scenario where we have got to choose between two projects, and sometimes we see that IRR is higher for project B, but NPV is higher for project A. Should we go for the NPV higher A or IRR higher B? What should we choose? In such a scenario, the best method, see, since the IRR assumes that the cash flows are reinvested at the IRR rate, and NPV rather assumes that it is reinvested at the cost of capital. NPV is considered to be a more realistic approach, and it gives the absolute increase. In mutually exclusive cases, NPV is recommended. Ranking projects as per NPV is recommended. Now let's have a look how this suggested answer is supposed to look. With the suggested answer loaded, let's have a look at it. NPV looks at absolute increase in wealth, whereas IRR looks at relative increase. And while doing a relative increase, the IRR ignores the size of the investment. NPV is not subject to any technical difficulties, but the IRR is subject to technical difficulties. Now, the NPV of a project, proposed project, is calculated at what the cost of capital, which will help us to calculate the increase in the wealth in absolute terms. In this way, we'll be able to, yes, look at the objective of the company, which is about maximizing shareholders' wealth. The IRR calculates the rate of return, which shows the attractiveness of a project to the shareholders. It does not calculate, the IRR does not calculate the absolute increase in wealth, and we can say that the NPV has got more advantage over IRR. In case of mutually exclusive projects, it is possible to say that at times, the IRR ranking is different from the NPV ranking. IRR ranking might be higher for project B, but NPV ranking might be higher for project A. Now, what to do? To go for A or B? A NPV is higher, B IRR is higher. Which one should we go for? In such a scenario, the best method to be adapted, NPV assumes reinvestment is more realistic, and hence ranking as per NPV is recommended. Now, with regard to the C option, C requirement, comment on finance manager's preference to NPV for investment appraisal. Here, the manager's remuneration is not based on NPV. What is NPV? NPV is a method that seeks to increase shareholders' wealth. NPV looks things at long term. NPV is looking at taking more risk. Hmm? But managers' remuneration is not based on NPV. It is based on annual profits. It is based on their performance evaluation, which is directly linked to the short term financial metrics, such as annual profit. So in such scenarios, we see that managers, they tend to prefer short-term results, such as, what is it, annual profits, short-term targets, and this results in sacrificing long-term values such as NPV. So we can generally conclude that managers' remuneration is dependent on annual profit, not on long-term returns. They're not willing to take large risk on large expenditure of projects, and hence managers, they generally don't adapt or prefer NPV. Now, looking at that suggested answer, so here, what do we have? We have uh, NPV method is based on the assumption to seek shareholders' wealth maximization. Managers may prioritize annual profit over NPV because their performance evaluation or compensation may be tied directly to short-term financial metrics like annual profit. This can create a situation where managers focuses on optimizing short-term result to meet performance targets, even if it means to sacrificing long-term values such as measures such as NPV. Managers' remuneration depends on the level of annual risk and not on long term returns. Thus, managers may be unwilling to take risk on large expenditure on project that offers only good long term returns. So, how do we conclude? So, generally, managers don't prefer or adapt NPV. And this is the last requirement of this question, Nexus PLC. Well, that's all for now. Wishing you all the best for your upcoming exams. This is your FM expert tutor, Rashad Hussain, signing off. Thank you.